Today I watched a video from my friend Chicken where he talked about timeless investing principle that will make you a great investor. One of the principles that he mentioned is to think like a business owner. In this video, I'm going to share with you how I put this into practice. For most investors, buying a stock is buying into a ticker. How do you make money investing in stock? Buy at a lower price, wait the price goes up, sell the stock and cash in the profits. Easy, right? The answer is no. If you do this often enough, you will notice that sometimes after you bought the stock, the price tanked, just like what happened last Friday. Then you are questioning yourself, what should you do? Should you just sell the shares or set a stop loss to cap your losses? Should you join the backholder club and hold these stocks for the long term without thinking much why you bought the stock at the first place? If you continue with this kind of thinking, you will make yourself think like a speculator or even worse, a gambler. There are many people who are in the stock market for many years and still can't make money because they don't have a plan. They are essentially treating the stock market like a casino. How to think like a business owner? For one, you need to pay less attention to the stock price and more to the fundamentals of the companies. What do I mean by fundamentals of the companies? First, you want to pay attention to the business model of the company. Second, you want to track the performance of the company, such as revenue growth, earning growth, profit margin, free cash flow generation. Third, you want to continuously assess whether the strategy adopted by the company is working. If the thesis is not working, then you have to consider selling your shares and move to the other investments. Now, I want to be more specific and use TSMC as an example because I have been following this company for years and I understand their business model, and so I can provide some insights from the perspective of a TSMC business owner. The company business model is very simple. It is a semicon company that focuses on chip manufacturing. They do not design the chip but only manufactures chip designed by other companies such as Apple, Nvidia, AMD, Intel and others. This is also known as foundry model. This foundry model offered huge business advantages to TSMC through economy of scales and the opportunity to enhance their production's capabilities. Unlike the integrated device manufacturing model or IDM model used by Intel, where the manufacturing is mainly serving one client, which is Intel themselves, TSMC serves many customers. These mass productions of chips help TSMC achieve cost efficiencies through economies of scale. The fixed costs, which can be extremely expensive, such as R&D, can be spread out over a huge number of chip production. This is why you see that TSMC will never lag behind when it comes to R&D, because it is very hard for other competitors to outspend TSMC. TSMC spends more than the others, but they are still able to produce profits just because of the scale. TSMC accounts for close to 60% of total foundry market shares, and the second largest competitor, Samsung, is only 1/5 of the size of TSMC. This illustrates the size of TSMC. TSMC just reported their earnings. Let's take a look at some of the financial numbers. This chart is showing the quarterly revenue in US dollar. When I first invested in the company in mid-2020, the quarterly revenue was around 10 billion US dollar. In the most recent quarter, the revenue was 18.5 billion dollars, almost double the amount just 4 years ago. This is quite an impressive revenue growth considering that semicon sector just went through recession last year and we are now just started to see some slow recovery thanks to the AI trend. Second chart that I'm showing is the net profit margin. Margin is very important because if the revenue keep growing but margin is coming down, then we might not see the profit numbers to go up. TSMC margin has been hovering between 32% to 44% in the past 10 years, which is quite impressive figures given that TSMC is just a manufacturing company. Typical manufacturing companies are operating at a much lower margin because they tend to be commodity-like business. For example, if the factory is producing items that any other companies can easily set up new factory and produce the same thing, then it is very difficult to have a decent margin because other competitors will compete until the margin drop to a very low level. For TSMC, especially the leading edge process nodes, there are not many competitors. Currently, closest competitor is Samsung, followed by Intel. So TSMC definitely has a pricing power in chip manufacturing business. With that said, there's definitely some headwinds that is affecting the profitability. For example, the electricity cost in Taiwan has increased recently. I quote Vendor Huang, CFO of TSMC. After last year's 17% electricity price increase from April 1st, TSMC electricity price in Taiwan has increased by another 25% starting April 1st this year. This is expected to take out 70 to 80 basis points from our second quarter gross margin. Looking ahead to the second half of the year, we expect the impact from higher electricity costs continue and dilute our gross margin by 60 to 70 basis points. We also expect the higher electricity costs to indirectly lead to higher material, chemicals and gases and other variable costs. He also said that to manage our profitability in second half 2024, we will work diligently on internal cost improvement efforts while continuing to sell our value. Longer term, excluding the impact of foreign exchange rate and considering our global manufacturing footprint expansion plans, we continue to forecast a long-term gross margin of 53% and higher is achievable. Secondly, usually when TSMC is ramping up a new process nodes, it will dilute the gross margin. I quote vendor Huang again. Revenue contributions from 3nm technologies is expected to increase as well, which will dilute our gross margin by 3 to 4 percentage points in second half 2024, as compared to 2 to 3 percentage points in first half of 2024. Finally, as we have said before, we have a strategy to convert some 5nm tools to support 3nm capacity given the strong multi-year demand. We expect these conversions to dilute our gross margin by about 1 to 2 percentage points in the second half of 2024. To manage our profitability in second half of 2024, we will work diligently on internal cost improvement efforts while continuing to sell our value. Okay, I'm not an accounting expert, but my understanding is that the new process nodes will require new machinery and the utilizations of these new machines will incur a higher depreciation charges, hence lower profitability. But this is not a concern because as they started to ramp the productions towards next year, the depreciations will become lesser and we should expect to see the increase in the profitability. Some investors think that it is too troublesome to watch all these profitability metrics and they will rather just look at the free cash flows and dividends paid by the company. On these two metrics, TSMC has been doing very well. As you can see in this chart, free cash flow has increased significantly in the recent 2 quarters because TSMC has been cutting the capex. Cash dividends is also increasing, and I quote vendor Huang again. Our dividend policy is, in principle, to pay 70% of our free cash flow in a year as cash dividends. So I would not just look at quarterly free cash flow to make a judgment. But indeed, as we said before, now that we are harvesting the heavy investment that we did in the past few years, we expect our dividend policy to switch to steadily increasing from the sustainable in the past few years. Let's switch gear and talk about the opportunities ahead. First, AI. As mentioned in the previous video that I made, smartphone market recovery is still quite slow, but TSMC saw high growth in the AI related products. I quote C.C. Wei, CEO of TSMC. The budget for hyperscale player, their wallet share shifted from traditional server to AI server is favorable for TSMC, and we are able to capture most of the semiconductor content in an AI server's area as we define the GPU, HAI network processor, etc. Well, we have a lower presence in those CPU-only, CPU-centric traditional server, so we expect our growth will be very healthy. One of the analysts asked about the advanced packaging and more specifically CoWoS. By the way, CoWoS or chip on wafer on substrate is a method used in making computer chips where multiple chips are put together in a single package. In this process, several chips are first mounted on a silicon wafer. This setup is then attached to a larger substrate which provides the necessary electrical connections between the chips and the external environment. This approach allows for a high density of interconnects and can support large bandwidth, which is particularly beneficial for applications requiring high-speed data transfer, such as servers, high-performance computing, and networking equipment. C.C. Wei said, and I quote, "The demand is very, very strong, and we have done our best where we put all the effort to increase the capacity. It's probably more than double this year as compared with last year. However, it's still not enough to meet customer demand, and we leverage our offset partners to complement of TSMC capacity to fulfill our customers' needs. Still not enough, of course." As you can see, in terms of the semiconductor trend, whether we are talking about the advanced process nodes or advanced packaging, TSMC continue to stay at the forefront of the industry. So even during the semicon industry slowdown, TSMC is still doing better than the competitors. Because they have been putting a lot of money in R&D, the work that TSMC is doing cannot be copied easily by the competitors. That is why their value propositions doesn't turn to become commodity easily. To maintain these positions, TSMC cannot slow down and need to continue to invest in the technologies of the future. So as you can see, as a business owner, I take the time to read the financial transcript, pay attention to the company strategy, executions, and also the challenges that they are facing. If there are good news like higher free cash flow and dividends, I'm happy. Let me share something with you. I just checked my statement record and I realized that I have received close to 1,000 Singapore dollars of dividends from TSMC last year. This year, I expect to receive more than 1,000 dollars. My investment strategy is not a dividend strategy, but when company is able to generate increasing free cash flow and paying higher dividends to investor, it shows their strategy and execution is on the right direction. So to conclude, instead of paying too much attention to the share price, learn to think like a business owner. Follow the company's fundamental, adopt a long-term mindset. I can't promise you that this strategy is able to generate outperformance as compared to those who keep switching stocks and chasing the next big trend. But it definitely can ease the anxiety of looking at huge drop in portfolio value, something like this. Alright, that's all I have for this episode. Hope you enjoy. Remember to like, subscribe, and follow. See you in the next one.